Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, January 11, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And what a day today. The S&P 500 rallied up another 0.75% for the most part. The S&P cash index was up 19 points. The SPDR was up $2. And it's just an amazing run that we're on. We're obviously far extended from home base, which is the 20-period moving average. But like I always mention, the market can stay overextended, whether it's on the up or the downside, for longer than most people think it can, and certainly longer than people can stay solvent if they're on the other side of the market. Which brings me to my next point, which is, this is precisely why we don't try and pick tops in markets, because we have to wait for a signal or a sign of a reversal. We never really got one, and the market continues to power higher. We're in the midst of a melt up, and it's a fool's game to try and pick a top. You just can't do it. You might get lucky once or twice, but 7 or 8 out of 10 times you're going to be wrong, and that's a fast and furious way to lose money. We don't want to do that, so we don't try and pick tops. We wait for a signal of a reversal, and we just never got one. Just because the market's overbought on all the metrics that we use to determine overbought conditions, that doesn't mean that the market cannot continue higher, and it is continuing higher. Yes, it's overextended, and eventually you're going to see it pull back, or you're going to see it go sideways and let the moving averages come up towards price. But right now, we're in a melt-up situation, and we just have to go with it. Remember, the trend is your friend until the very end. So I'm not going to try and pick a top. I'm not going to try and tell you where the next price target is. The market's just powering higher. It is what it is. If you're long the market or you're long stocks that are following suit, you just trail your stop along the way and you try and stay with it for as long as you can. So tonight, what we'll do is, let's take a look at what were the divergences yesterday and what happened today. Last night in the video, we discussed the divergence. There was a certain pattern on the hourly chart of the SPDR, and there was a different pattern on the hourly chart of my favorite leading indicator, the IWM. So we're going to look at both, and then we'll head over to the other markets and take a look at what we see there. So let's go to the hourly chart of the SPDR. So remember, yesterday we had what could have been and was, in fact, a bearish pattern. So we had a down move, and we were going in a sideways wedge fashion, which generally will play out to the downside. We talked about some possibilities on the downside if it were to play out that way, and so that definitely was a bearish pattern. Well, none of that downside happened, so let's talk about what did happen. We had the opposite takes place, and therefore we had what we call a failed bearish pattern, and it went in the other direction. So the same energy that would have been released on the downside had this pattern played out. So had this pattern played out like this, that same energy that would have normally been released on the downside was released in the upward direction, and that's what we saw today. But that's not, in my opinion, why it happened. This wasn't the leading indicator, right? This was what was pulled up with as a result of the IWM, in my opinion. So let's take a look at the hourly chart of the IWM. Remember yesterday, we discussed this bullish pattern that was developing, and I said this is a bullish pullback pattern, a bullish pattern that will generally play out to the upside. That was the divergence that we discussed, and that's precisely what happened. Now, out of this pattern, we wouldn't normally see the kind of move we saw. The IWM was up 1.7% today, $2.63. That's a tremendous move in the IWM. Let's take a look at the daily chart, because obviously we have new highs, and this is what took place. We were not breaking out in the IWM when we were in the Spider or the S&P 500, in the Dow and the NASDAQ, and now the IWM is actually playing catch up and led the markets in the upward direction today. This is my favorite leading market indicator. How do I know it led the markets? Because it was up the most out of any of the markets. Yeah, it was playing catch up, but it was still up the most out of any of the major markets. Forget the transports for a second. We'll get to that in a minute. I'm talking about the NASDAQ, the Dow, or the S&P. The IWM was the leading market indicator, up 1.7%. The Dow is up today, but it was up less than 1%. The NASDAQ was up less than 1%. The S&P was up less than 1%. The IWM was up double them all. There's no other way to interpret this behavior than bullish. Again, we're going to have pullbacks. It's just a matter of when and also from what price. We just don't know that yet. We're at new highs in all these markets, and there's just no way to pick a price at new highs. Sometimes we can, but at this point in time, we're in the middle of a melt-up, and it's a fool's game. All we have to do is wait for the market to tell us by way of having a reversal, an intraday reversal, where at the end of the day, the daily candle will be obvious that the market reversed, and that will be the sign, or at least the first signal, that the market's going to go into at least a short-term corrective phase. We have nothing like that right now, so right now, the trend is your friend until the very end. I think something also important of note today is the VIX. Now, the VIX, even though the markets were up today, the VIX was not down, and it generally would be. So whether or not it's the result of buying protection against a long portfolio or not, well, that remains a mystery. But I thought it was important just to point out, while we're still below 10, you would think with the type of up day we had, the VIX would have been down today, would have been down at least 3, 4, 5% or more. And we're not. We're still elevated compared to where we were a few days ago, down at the lows around $9 a share. So I've got my eye on the VIX. It is interesting why it wasn't down today, so I'm going to keep watching it over the next several days, but I thought it would bring it to your attention anyway. So the transports. Now here's another market that is just in a absolute melt-up phase. We were up 2.3% today. The transports were up 254 points. It's just remarkable what's going on in all these markets. This is a melt-up. So if you were ever wondering what a melt-up looks like and you haven't seen one before, this is what they look like. You can see here this is just in a perpetual uptrend. We're getting extended from home base, but that doesn't mean we can't go higher. Where can the transports go? The only thing I can suggest in terms of where we might find some level of resistance, since we are in no man's land, I would say the only thing I could keep my eye on is 11,500 and then 12,000. In between, there's just no point in trying to pick a top in the transports. Just let it go. And if you're long any of the transportation stocks, you just trail your stop along the way and go for the ride. There's nothing else to do. Let it go. It's an absolute melt-up. It's pretty remarkable. And of course, this too will eventually pull back, but it will pull back when it's ready to pull back. We'll just call it a melt-up, and when the market decides to reverse, we'll know it when we see it. Up until that point, it's in a bullish uptrend, no two ways about it. The gold market. So gold is trying to edge its way higher. We've been going back and forth in this consolidation pattern in this range here for several days now, and we're starting to, at least it looks like, we're starting to break upward. We can certainly come back down and go back and forth for several more days. The longer we do this consolidation pattern in gold, the more likely we are to go higher when we do break out of this, if we do break out on the upside. Now, if we fail, the first indication of a failure would be a close below, that's the wrong tool, a close below the low of this green candle. That would be the first indication that this pattern, this bullish pattern, is going to fail. But if it doesn't fail and we do go higher, we're going to look for 1338 to 1340 on the upside. Nothing's really changed from my standpoint in the gold market. The chart looks bullish to me, but it's very hard to be long in the midst of these consolidation patterns because we can certainly go down and test the lower end of the range. At the lower end of the range, that's where I prefer to buy a long position or take a long position out of a consolidation pattern because we're minimizing our risk. So for example, let's say I wanted to be long the gold market. I know that the first indication that this pattern is going to fail would be a close below this green candle. Now, if I bought close to the low of this green candle, I know what my risk is, a daily close below the low of this green candle, and I'm going to move out of that trade. What this means is buying gold on a down move closer to 1309, 1308, 1307, 1310, that certainly has much, much less risk, obviously, than buying it at 1323. However, it is a bullish pattern. It looks like it wants to move higher. It may move higher, and it will do so without me unless it comes down to test the lower end of this consolidation range. That's the only point in which I would consider a long trade in the gold market. It's just a matter of how I like to manage my risk and where I would normally enter a trade looking for a move upward. I want the best price possible, and sometimes I just don't get it, and the market will go without me, and that's okay. There's always another trade around the corner. Looking at crude oil, remember the last couple of videos we were discussing the near-term resistance was likely to be around 63.5 to 64. You can see what happened today. It looks to be like we're putting in, and the official close of the crude futures contract hasn't occurred yet, but if we closed where we are now, for example, this would be a tail candle, and it would be an indication that it's a topping tail, at least on a temporary basis. It doesn't necessarily mean 100% of the time we're going down, but the majority of the time, this would be a topping tail indicating that short-term, at least short-term, lower prices are coming. So you can see where, at least at first blush, it looks like that 63.50 to 64 area for now seems to be somewhat of a resistance point for crude oil. However, doesn't mean we can't move higher. We could just go sideways for a few days and then resume the move higher. This is in, just like the stock market indices, this is in a melt-up phase. This is in an uptrend. It's very powerful, and the trend is your friend until the very end, and you don't really want to be short crude oil here based on this topping tail. What we would want to do is look for an area to be buying into support on a pullback because this uptrend is intact, and you really don't want to fight the trend. Like the other markets, we are far extended from home base. Home base is the 20-period moving average, and the likely scenario is at some point we're either going sideways, we're going to come down, we're going to let the 20-period moving average come closer to price. That's generally what will happen, and you can just see it here on the chart. How many times have we gotten this far away from home base just on what we see on the chart here? I can go back in time, and you're going to see much of the same thing. We just don't get too far away from the 20-period moving average for too long of a period of time. Here's one where on the upside we were extended, here on the downside we were extended, and you'll notice that we always come back toward home base. And that's what I would expect to have happen this time around, just the same. At some point in time, we're going to have to reset, like all the markets, and come back toward home base, the 20-period moving average. And with that, folks, it's pretty much everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.